Hey there. If you're thinking about retiring early, 2025 might not be the best year to do it unless you've set yourself up to be able to crush three enemies to early retirement that are really rearing their ugly heads this year. And stay tuned to the end where I'll go over how to tackle these three enemies. And if you're all set there, then you may be set to pull the trigger in 2025 to retire if you were planning on doing that. The first one is something that doesn't get near enough attention as we're always focused on saving for retirement and hitting the right number in our investments to do it. But a lot of people don't realize it's not all about hitting that number to trigger retirement, but you also have to be careful about when you're pulling that money out to fund your retirement. You have to plan for enemy number one, sequence of returns risk. Now, it may sound technical, but it's not. Here's what it really means. If you have a market downturn early in your retirement and you're withdrawing from your portfolio at the same time, the damage can compound fast. It can become hard to recover from it. Think of it this way. If you're still investing during a downturn, you're buying stocks at a discount, and we all love that. But if you're retired and selling during a downturn, you're selling your investments at a lower price too. Here's a great example of this. If you retired in 2008 with $1 million in stocks, the market crash would have cut your stock investments by more than a third within the very first year. As a result, the amount you're withdrawing to fund your retirement, even though it may be the same amount all the time, you're now taking a much larger percentage from what's left due to the market crash, draining your savings even faster. So enemy number one is a bugger and all about bad timing during a market downturn. But enemy number two, it's way sneakier. It can quietly wreck your retirement plan even if the market doesn't crash. This enemy is inflation. Let's rewind back to 1966. So even before I was born, because it was one of the toughest years in modern history to retire. Now imagine you plan to withdraw $44,000 a year to live on, and you felt that you could have a great lifestyle. And with that amount per year back in 1966, you probably could really enjoy life. But here's the problem. That money would not be able to hold its value. Inflation in the late 60s and early 70s was brutal. Prices kept rising year after year. So even though you're technically pulling up $44,000 a year, what that money could buy kept shrinking. After 15 years, that same $44,000 had the purchasing power less than half of that, around $17,000 in today's dollars. Imagine trying to live off $17K after planning for $44K initially. That's massive. That's what inflation does. It's a slow grind that chips away at your purchasing power year after year. Even with a mild inflation rate of 3% a year, well, that cuts your buying power in half in about 24 years. And what's scary is we've certainly had years in the recent past when the average inflation rate was above that. For example, in 2022, yikes, it was 8%. And in 2021, 4.7%. And we've been hearing in the news that it may be creeping up again. One potential reason being the tariffs that are all over the news. So even if the market was to remain strong, inflation requires you to withdraw more from your retirement funds to maintain the same lifestyle. Now we've covered two big threats, sequence of returns risk and inflation. But enemy number three is not as obvious, at least to me, as the first one, but it's definitely out there. It's valuation. Here's what I'm talking about. After the last two very strong years in the market, stocks are expensive, like historically expensive. There are a couple of ways pros measure this. One is the CAPE, or cyclically adjusted price to earnings ratio, which was created by Nobel Prize winning economist Robert Shiller. It looks at the average price to earnings over 10 years to smooth out the noise. And right now, it's sitting well above its long-term average, meaning investors are paying a premium for every dollar of earnings. Another is Warren Buffett's favorite, the Buffett indicator. It compares the total stock market value to the US economy's gross domestic product, or GDP. When that ratio hits 2 times, like it did in 2024, it's a flashing yellow light. Not a guarantee of a crash, but definitely a sign of caution. So, what does that mean for early retirees in 2025? It means you might be starting your retirement at a time when markets are overvalued. And if a correction hits in the first few years while you're taking money out, you're back to facing enemy number one, sequence of returns risk. Now, I'm not bringing all of this up because I'm some doomsayer. I'm trying to best prepare you for the realities of retirement, especially in today's financial climate. Because the reality is, once you retire, you just don't want to lose what you've built. Financial independence and the ability to retire is something we only have to achieve once, but we have to make sure we protect it every year after that. So we've covered the three big threats to early retirement: sequence of returns, inflation, and high valuations. But here's the good news: you're not powerless. And it doesn't mean you can't retire in 25. You can if you have the right plans in place. So let's talk about how to fight back. To defend against sequence of returns risk and market valuation, the best weapon is simple: having cash reserves. You want enough in alter-safe liquid assets like high-yield savings accounts or money market funds to cover your expenses during a market downturn. That way, you're not forced to sell stocks while they're down. Now, a common rule of thumb is to keep 1 to 3 years worth of expenses in cash. However, that may not always be enough because bear markets can last 1 to 2 years, and then you have to plan for the recovery as well. So a more conservative strategy may to keep 3 to 5 years worth of expenses in cash. Think back to 2008 or the year 2000 where markets dropped hard, but they came back. But if you had enough cash to ride out those few ugly years, you'd be fine. Now let's tackle inflation. The way to beat inflation is to make sure your money is growing faster than prices are rising. That's where your investment mix comes in. Historically, some bond-heavy portfolios have barely kept up with inflation and sometimes even underperformed after taxes and fees. That's a problem if you're planning a 30-plus year retirement. Instead, consider mixing in safer assets other than bonds that will outpace inflation over time, like dividend-paying value ETFs. These tend to focus on solid, profitable companies that generate real cash flow. And many of them raise their dividends over time, which can give you a built-in hedge. But keep in mind that dividends are not guaranteed, and these funds still carry market risk, so another option that's really safe you may want to consider and research are TIPS, Treasury Inflation-Protected Securities. They are U.S. government bonds that are designed to protect against inflation. They adjust with inflation as their principal value adjusts monthly based on the Consumer Price Index. The bottom line is a strong early retirement plan isn't just about hitting a number, it's about building a resilient strategy. One that survives bad markets, rising prices, and stretched valuations. Because once you retire and leave the 9 to 5, the last thing you want to do is be forced back in a few years later to the workforce, and think about how hard that would be. So plan smart, stay flexible, and don't let these enemies catch you off guard. Now, I want to hear from you. Were you planning to retire in 2025? Have your plans changed with everything that has been going on, or have you set yourself up to safeguard against these three enemies? Drop a comment. I'd love to hear from you. Well, that's all for today. If you found this information helpful, please hit the like button and subscribe. I sure would appreciate it if you did. It really motivates me to continue producing these videos, and it just takes a moment and of course is of no cost to you. And if you're on the go, check out my Early Retirement Roadmap podcast wherever you get your podcasts, and visit mikeupland.com where I have all of my media. And I have a brand new retirement channel called Early Retired and Real, where I talk about my personal experiences about early retirement. So if you're thinking about retiring early, You get to experience it before you take the leap from someone living it. Or if you have early retired, it's great to kind of just align with the same experiences someone else is going through. So until next time, take care. This is Mike Upland, and make the most of today.